Hello everyone, my name is Nitin Kothari and I've been joined by the CEO and co-founder of Samco Mutual Fund, Mr. Viraj Gandhi.
Hello.
At the current juncture, there are a lot of questions which are on the minds of clients as well as partners like us. So we would want to prick your brain and try and get few understanding out of that. My first question to you would be that Samco Mutual Fund practices or utilizes momentum as a factor because it is the highest alpha generating factor, most persistent factor. Those are all the good parts of momentum. But if you look at the sharp drawdowns that momentum it gives a lot of jitters to the client. Even partners like us are not able to control the emotions of the client. So if you can give us some guiding factors, how can we control that anxiety for our clients and as well as our partners?
So it's a very important and a fundamental question when you're playing momentum as a factor, particularly for people who are new to this particular style of investing. Because people come only with one side of an expectation as to how much more can you make through the factor which is called momentum. But we need to understand that in markets, whenever you see a high return product, it always comes with a very high risk associated to it. What do I mean by that is momentum as a factor is actually a 2x factor. When your broader market goes up by 20% or 30%, momentum as a factor goes up by 50%, 60% and maybe even more. So if you are going to enjoy that kind of fruits in a rising market, you will have to bear that kind of pain also in a correcting or in a sideways market, which it is in the past 365 days. That Nifty has gone down by approximately 5%. The broader index has corrected and then bounced back. But during this phases, momentum as a factor will actually be a 2x factor in a rising market also and in a falling market also. So one need to understand that there is nothing called as low risk high return. Momentum is always going to be a high risk high return product. Now if you want to see that return part of the market where you are on the right side of your trade, you need to absorb the volatility of the short term, and volatility of the short term you need to absorb by keeping the right allocation of the client in that particular segment. So you need to first check whether the client is in this particular product for up to 3 years, 3 to 5 years or more than 5 years. Why am I giving you this understanding is because the long term historical data evidence that we have on momentum suggests that if you stay on course for more than 3 years in any momentum style, then on a 1 year, 3 year and 5 year rolling basis, you are on a very high probability game of being on the right side and beating the benchmark indexes. But when you see the short term volatility and you have a higher allocation of the client, that is where the anxiety goes up. So for managing that anxiety, you need to make sure that the right allocation to the strategy momentum is done for the client. So what do I mean by this? Let me sum it up. So let's say if your client has a 1 crore portfolio and you as a distributor have showed him different buckets in which he has to manage his risk. Okay, this much should be large cap, this much should be mid cap, this much should be small cap, and this much should be multi asset, this much should be hybrid, and you have created this allocation for him. Now let's say if you have taken a 20% allocation towards small cap out of 1 crore, that means he has 20 lakh rupees of investment through different schemes in small cap, whichever you have suggested to him. At this point of time, looking at the data, you should only have a 20% allocation to momentum style of the 20% that you have already allocated to small cap. So out of that 20 lakh rupees of the 1 crore portfolio to small cap, 20% of 20 lakh, only 4 lakh rupees should be pegged to the momentum style of small cap momentum.
Absolutely.
Now if you keep this math in place and allow him to sail through, then the volatility is only part on that 4% portfolio of his overall portfolio. The rest 96% of its portfolio is doing what is supposed to do anyways. Absolutely. So you can say that 4% portfolio is like your satellite portfolio, an impact portfolio or a X factor portfolio, which will be volatile in the short period of time, but it will create that alpha if you have that right allocation over the next 3 to 5 year period.
Thanks a lot, Viraj, for that wonderful explained answer. My two key takeaways from this as a partner would be that number one, there should be clear expectation setting to a client. When he's playing momentum, he's playing for the high return game, but at the same time, he has to understand that there will be high drawdowns also in the portfolio. But the second key aspect should be how much of that allocation should be in momentum strategies. As you rightly pointed out, if a client has got about 1 crore of portfolio, where 20% is in the small cap space, only about 20% of that 20% should be allocated into momentum strategy, which basically means out of 1 crore, only about 4 lakhs should be invested into a small cap momentum based strategy, which ensures that across time frame there is consistency in performance and he keeps his anxiety also in check. Thanks a lot for that answer.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.